We're going to roll right into it. Once we roll right into it, and I'm going to start with Shark because this was his idea to set this up. And essentially, what I'm going to have each speaker do, and Josh is going to do the transitions between speakers, is just start by talking about, why you got into technical analysis, what your favorite indicators are to use, what your process looks like, if there's certain stocks you lean towards, go away from, the whole shebang. And since we only have four speakers, feel free to take, 10 minutes, show your position. If you want to go a little shorter, we'll move in between and then maybe have some questions at the end. So I think that sounds hopefully good to all my speakers. So Shark, I'm going to turn it over to you.
All right, thank you very much, Wolf. I appreciate that. So I'm going to go ahead and break down a few things. I'm going to give you guys a little bit of background about me. I cut my teeth on the proprietary trading firms growing up, and I've always been into coding. So when I got into the proprietary trading firm, I started in the algo department, and that's how I learned technicals. So technicals is something that I've been doing for several years. It's something that I really enjoy. And so I'm going to dive in and not get too much into the weeds, but I'm going to discuss a few things that I use on the daily. Okay, so the first is going to be um, that's going to be my first one that I will discuss. And then also I'm going to discuss relative strength index. That's going to be my second one. But what I want to do first is I want to give you guys a little bit of um, a rundown of what I do daily to find my different stocks. So the first thing that I do, and this I learned at the proprietary trading firm, was I do a top-down approach. So what I like to do is I look at my futures, I look at my indices, and I look at my sectors, and I like to see what is the trend of the day. And then based on that trend of the day, what I like to do is see, are my targets going to be getting reached or not moving forward? So every day when I come to the market, I make sure that I always have a plan. I never come to the market ever without having some kind of chart analysis before and making sure that I have buy targets and sell targets on each side. The sell my stop loss, and then when my bar targets is reached, that's where I'm going to be indicating trades or not going to be indicating trades. So now let's go ahead and jump into some of my technical analysis. So what I'm going to be looking for every single day is what I'm looking for is an 8-day EMA crossover over the 21-day. When that happens, that's when I'm going to be initiating a buy on most of my stocks. When that usually happens, okay, that's usually initiating a faster EMA, which is going to be the 8-period EMA. It's going to be crossing over our 21-day EMA, which usually it's a nice average for most people. Every person is different. I like the Fibonacci numbers, so 8 and 21 fall under those Fibonacci numbers, and that's what I'm looking for. And then when I get to the RSI is something that it basically it measures any trading vehicle's strength by monitoring changes in the closing price. Something that I monitor very closely, especially being a swing trader. I don't intraday trade as much as some other people do, but what I like to do is I like to see stocks that are extremely oversold. Um, Usually, right now there's a bearish market. I'm actually using more of the 20% and 60% on the RSI, and I'm looking for stocks that are going to be bouncing off of that 20% level and looking to recover close to that 50 level, especially in this market. In 2020, it was awesome. I was using more of an 80-40 level, and I was looking for stocks that were breaking that 50 trend and moving their way up. Um, but for me, what I like to see is I'm looking for the RSI to be diverging from the price. And that's key for me. So when I get into the RSI, when the RSI is starting to go up, when our price is also coming down, that's going to be a buying indicator because it's a bullish divergence. And then on the other end, when the price is going up and a bearish divergence, and then I'm going to be looking to sell on some of those. So that's just a quick little wrap up of mine. I don't want to take up too much time, and I can take any more questions from you, Wolf.
So Yeah, just so everyone knows. So first off, thank you so very much, and I'm gonna have Josh do follow-up questions and intros, and he's taken some great notes too. So I'm fascinated.
Yeah, thanks, Chart. So you brought up RSI a lot, relative strength index. So I'm curious, can you explain that a little more for the listeners and how you use that?
Yeah, no problem. So the RSI is something that I look and look for every single day. I mean, it's one of my keys because it's not a laggard, it's a leader. Usually, what's going to happen is when the RSI is going to diverge from the price, it's going to happen beforehand. So usually, you'll see an RSI starting to uptrend while maybe a price is pulling back. And when you do see that, that's going to be a good buying opportunity because we're having a bullish divergence action. So when that's happening, that's going to be something that I'm looking for. I am not a short seller, so I try to always stay on the buying side. And in this market environment, it's been difficult. But like perfect example today, on my Twitter, I called out APPH for a break of 12.50, and today it did. It got up to 13 plus, and that's a nice little intraday trade of 50 cents. But I still like that as I think it's going to be continuing up in the RSI trend, and I still think that stock currently that's in the 13 area will be up into that 16 by late this week. So that's kind of how I use RSIs. I'm looking for that divergence in price action, if that makes sense.
Okay, interesting. And another quick question I have is you said you mainly look for oversold stocks. So are you playing the price down and shorting, or is that unrelated when you're doing technical analysis?
Yeah, so I'll be honest. When I first got into this industry, when I worked in the proprietary trading company, they wanted you to do a lots of trades. So I did trade on both sides early on, but I don't do that anymore. What I actually am doing is I look for companies that are oversold that are starting to base at that oversold area. I don't keep buying. Another indicator that I use is Bollinger Bands. So say if a stock is starting to completely sell off. I will not buy while that price is outside of our Bollinger Bands. I'm looking for it to start to settle, base, and at least show me one green candle off of a severe pullback. And once I have that one green candle day, now I can start to look for my price targets on where I'm looking for on the uptrend. And then at the same time, if it decides to pull back to a certain area, that's when I'm going to be deciding to either have my stop loss or I move forward and we look for another opportunity.
All right, solid stuff. Thanks, Shark. All right, I think we're gonna move on now to Ben. So Ben, if you could just, you can start and just start riffing.
All right, great. Thanks. I appreciate it. Thank you for having me. I'm going to talk a little bit more about the psychology. I'm a big pattern trader. And behind these patterns, most of us see them play out in the charts and we discuss support and resistance. But there's actually a psychology behind why that pattern takes place. Usually, let's talk symmetrical triangle first. If you think about why that triangle starts, it's because there's an imbalance in the buyers and sellers. And usually, let's say if we're in an uptrend, those buyers are exhausting or we're running out of them. Sellers are stepping in, maybe short sellers. So price starts to come back down. Well, eventually those buyers step back in and we start to get what starts as a symmetrical triangle, our wider range of the triangle. So just to throw an example out, let's do Funko, FNKO. So you have kind of an exhaustion candle a few weeks ago, tags 25, stock pulls back, comes back down to below 20, comes back to 19. Buyers step back in, not able to push it back all the way to those prior highs, but we reach 22, 22 and a half. We're at kind of the midpoint. So now you kind of have your upper range, you have your lower range, which is that initial push from 16 to 25. Then you're starting to form that triangle from 25 to 19. Can't take out the high. You have a balance at that point, and the stock starts to move sideways. Your buyers and your sellers at that point are equal. They're accepting that price, which is kind of the apex, let's say, of your triangle. How do you know that? Well, you can start to look and see that the volume is really easing up. You had big volume on the way up. You had big emotional sell there off the top as buyers exhausted and the sellers stepped in. So you saw those big volume candles. And then not only does the volume, as price starts to accept and we get closer to the apex of that triangle, the volume starts to ease up. Additionally, the range, your daily range in price, it starts to contract. So you start to see, and this happens on all time frames. I'm using the daily as an example, but you can find this on the 5 minute, the 30 minute, the weekly, you name it. It happens on all time frames. So when you start to see that volume ease up, and you know by looking at the price action, we're close to the apex there of the triangle. There's going to be an imbalance here shortly, because from contraction comes expansion. So oftentimes on my feed, you have me, I'll share inside days, I share outside days. And what I'm actually doing when I'm sharing that inside day is saying, look, here on the shorter time frame, here's a consolidation. And from that consolidation, we're in balance here, but there's soon going to be an imbalance. And when we get that imbalance, when that comes out of that inside day, or it comes out of that triangle to the upside or to the downside, if you're selling short and in a downtrend, like I said, it works both ways. That's where you can really capture gains rather quickly. And again, it doesn't really matter what your time frame is, but when you see that triangle start to break to the upside, and especially when you can zoom into the shorter time frames and see that volume coming in and picking up. We watch relative volume to see the pace that it's coming in. That's your sign that, okay, things were in balance, but all of a sudden buyers, they've taken back control, and they've taken back control heavily. And now you start to see that price and volume as it comes out of that pattern. And that's basically, when you look at technical analysis and you think about technical analysis, it doesn't matter if you're using horizontal lines, if you're using diagonal lines, if you're using moving averages, whatever you may be using, whatever you're comfortable with. Ideally, as a trader or as an investor, even if you're on the bigger term charts, you want to be coming in one of two places. You either want to be buying down at support, so that if you're wrong and it moves against you, you can quickly get out. Or you want to be buying as that price comes through resistance, for the same reason. As you come through resistance, if it comes back below resistance, your stop is just below, you're coming out of there with a very tight, manageable trade where your odds for success and your downside are limited. You've got to have that good risk reward. And this is whether you're trading triangles, cup with handle, flat bases, 3 weeks tight. It doesn't really matter which pattern you prefer. If you can understand the psychology behind that, the participants, who's in control, where is the balance point? A lot of times on my chart, you'll see me share volume by price. And I share that volume by price as well as anchored VWAP, because price above that level tells me up here, buyers are in control. Below that level, the sellers are in control. I want to jump on board when those buyers are in control and price and volume is coming in and we're moving through resistance to the upside. And if I'm short selling, it's the exact opposite. I want to come in when that support to the downside is breaking. That's where I want to come in. If I'm short, I want my stop just above that level at support, and I'm keeping my risk. I'm managing it very tightly, but at the same time, my odds for success and capturing a bigger move have increased significantly compared to what I'm risking. Does that make sense?
Awesome. Some of it. I'm not extremely into technical analysis, so a lot of this is also insightful for myself. But I'm curious, are you only using limit orders, stop orders when you're trading technical, or would you ever use a market order?
Okay, no, I may use a market order. Majority of the time, I'm trying to come in with a buy stop. Going back to that Funko example, we knew today 2550 was a big level. That was the high. We had seen it rejected at that level a couple times. And I kind of recommend that if you're a new trader, the safest place to buy is as it comes through that resistance. So 25.50, give yourself 5 or 10 cents. If that takes out 25.50, you can have a buy stop right there. If you're not there, watching it. If you're there watching it, you can do market orders, especially if you're right in front of the monitor. But if you're not, using a buy stop, using a limit, you don't want to, especially something that really moves fast, or some of these biotechs, or really anything that's really thinly traded. If it doesn't have a lot of volume behind it, you need to use buy stop limit orders so that you don't get filled, 3% up above your pivot. That ruins the whole trade. But using buy stops, just above support, or if you're buying a dip, if you're buying down, it's okay to have that entry at that level limit of whatever your support is if you're buying down. But what you don't want to do, and the worst thing you can do, is buy just below resistance with an expectation for a breakout. Because then when it doesn't break out and it rolls over, you're kind of in no man's land. You don't know whether to get out. Should I let it come back to support, which may be 5, 6, 7% lower, which again ruins the whole risk reward of the trade. So you always want to make sure if you're coming in, you're buying at support, or you're buying on that move through resistance. And then your stops would be below those levels.
Okay, another question I have for you, Ben, is you mentioned that the strategies you're using, you can use them for whether you're tracking 5 minutes, 30 minutes, weekly. That surprised me. So is there a certain time frame you prefer? And do you really do find that the patterns are similar over longer time frames? And what is the kind of the highest you can go to where you start losing those trends? Can you do it over a longer term? Or
Sure. I think the weekly, when you start getting outside of the weekly, then it starts to become too big picture for really the technical analysis. But the weekly, looking at cup with handle charts or triangles, flat bases, consolidations, some of the bigger patterns, may still go over 6 months to a year. You could have a huge cup with handle pattern. There's one, Sting, STNG. This pattern goes all the way back to May of last year. But if you're looking at the cup and handle pattern on the weekly chart, we're just now coming out of the handle. It's just now starting to move out of there. So if you were to look at that pattern on a weekly, if you're looking at it on the daily, you may not even see it. But if you zoom out to the weekly, you can clearly see that cup with handle pattern, and it's a year in the making that's just now coming out. If you zoom in, if you're, let's say you're a swing trader, and let's say your time frame is usually 2, 3, 4 days. That's the most you're in a trade. You're getting the swing. Maybe use the ADMA like the previous speaker was mentioning. If you do that and you're in 3, 4, 5 days, you could always zoom into the 30-minute chart or the 60-minute chart and see these same flag patterns, triangle patterns. All of these that I'm describing on the weekly and on the daily, they also play out on the 30-minute, on the 60-minute, on the 15-minute. So it's really up to you. If you're a day trader, you've probably been watching these on the 1 minute and the 5 minute and just didn't really realize, that these were the same patterns that we see on the daily and the weekly.
Great point about zooming out. So thank you, Ben. Go off here real quick, just so everyone knows. Ben, I think you'll appreciate this. There's a faker out here trying to pretend to be Ben because Ben is, and their username is Patterns Profits, I think, with an extra S in the middle. And if everyone could look up patterns, profits, and report them, they keep trying to scam people in our wonderful community. And even though dozens of people have reported them, Twitter has not taken down that account, and they keep trying to scam people. So if everyone could report patterns, profits, that is trying to pretend to be Ben, that would be awesome. But thank you, Ben.
I appreciate it. Thank you.
Cool. Let's roll into Shinobi.
Yo, what's up?
Flipping it
Yo,
up.
can you guys hear me? All right. So I just want to start off by saying thank you for having me on here. So I'm not really gonna go over strategies on technical analysis. I just want to go over some just things I don't feel like are mentioned enough or just taught mainstream. So the one thing you guys have to understand about technical analysis compared to fundamental analysis is technical analysis only works because people make it work, right? So as Ben was mentioning, like wedges, triangles, all this type of stuff, they would never work if people like us weren't playing them, right? Who's going to be playing the breakouts? Like, I'm a breakout trader. I trade options on breakouts. When the stock breaks out, I'm, dependent on millions of other people seeing the same breakout and either FOMOing in or playing the same strategy, and we're just bouncing off other traders. So when that breakout happens, you're expecting millions of traders to see that key level breakout and buy up the stock or sell the stock depending on if you're going short or long. So you always have to keep that in the back of your mind, even with RSI. Every indicator, any technical now, everything works, right? There's no secret sauce to this. There's things that can make trading easier for you. And this has come from me. I have my own algorithm as well. But a lot of things work. RSI works, EMAs work, but it all works because people use it, right? The more popular the indicator like RSI, MACD, the higher chance of it there is of it working because there's millions of traders using it. Now there's things like the squeezes that the TTM squeeze I use, Bollinger Band, stuff like that help me identify trends earlier, that type of stuff. You always have to remember that the main thing I want you guys to get from what I'm saying is patterns only work because other traders make it work, and indicators only work because people make it work. Because if they didn't, there would be no breakouts, there'd be no support bounces, no resistance, rejections, none of that, right? And that's the main thing you want to know before you ever hop into a trade, before you ever hop into any breakout. That's why whenever every time you're about to enter something, say you're trading off one of my tweets, you're always going to hear me say, once this picks up volume, or if there's enough volume on this, I'll play this. Because volume and price action is everything, right? And technicals, those are the two things you got to learn the best, because those are what actually guide the stock. The indicators can help you out, but if there's zero volume on the stock isn't going to move, even if every indicator is lining up. So you have to learn price action and volume. And that can be done with like YouTube videos, courses, all that type of good stuff. Just those are the main two things you guys really need to hammer down in your brains, is just understand that a stock won't move if there's really low volume, and a stock won't move if there's or the stock will move if there's volume, but it would move very weird if the price action isn't up to par or up to your standards. So that's why when you see big Twitter people, when they call out stocks that have a short float, it's not necessarily them pumping the stock. What it can be considered is them actually like bringing liquidity to the stock, actually bringing volume to the stock, so the stock can actually make its potential moves, right? That's done many times before, and that's why it works. That's why Twitter works, that's why Furus work, all that type of stuff, because they're able to bring liquidity to a stock. Now when you're trading technicals and you're doing all this stuff, as I said before, keep volume in mind, because I see so many people coming to me every single day telling me, oh, the stock is our size, it's like 23 and the MACD is about to cross. And you look at the volume and it has under 10K volume for a stock that's $2 or $3. That stock isn't going to move at all. Even unless like it has a big surge in volume or a catalyst, it's not going to move if there's no volume. So always just keep that in mind, and remember not to beat yourself up when beat yourself up, but understand that indicators aren't going to indicators aren't the golden goose. They're not going to help you become a millionaire. What is just going to is just like discipline, persistence, and just understanding the two main things, which are price action and volume. So if you guys have any questions about those, you could go ahead and ask me. Yeah.
Okay, so price action and volume, two most important things for you. So I'm curious, knowing that, do you stay away from certain asset classes or certain industries, sectors, or do you just go for the trending popular stocks that have high volume? How do you use that with your approach?
All right, that's actually a great question. So, a lot of people come up to me, in my Discord chat or whatever. They're gonna be like, "Yo, check out this stock," and I look at it and it's printing barcodes on the charts, and I'm gonna, yeah, I'm staying away. I don't even look at the stock. I just turn it off right away. So it all depends on how the stock actually moves. If I see, so ready, listen here. So Amazon, Amazon's a $3,000 stock. It has $10,000 or 10,000 volume on a candle. That's considered a substantial amount because it's a $3,000 stock, right? It could even have a couple hundred volume on a candle, and it's still considered a lot for Amazon. It all depends on the stock, right? So me, I like playing mid to large caps. So just today, I caught 200% on UWMC contracts because it had like 1 or 2 mil volume right off open. So I knew it was going to move along with AMC and GME were moving. So, I always like to play stocks that have, an unusual amount of volume that are like, I'd say from anywhere from 10 to like $50 for mid caps, and then anything from 100 to 3,000 for large caps. It all really depends on, what the market sentiment is. So today I played SPY. SPY's always going to have volume. You're always going to be able to play SPY or SPX. So it all just comes down to the market sentiment. Tend to stay away from like biotech and just pharmaceuticals, just because they're so catalyst based that technicals don't really work on them as well as they should. But I really like playing large caps because 9 times out of 10 the technicals are always going to play out just because the volume is usually always there.
And also with extremely volatile stocks, I don't know, maybe GameStop or a lot of the trending stocks, you could argue meme stocks. Do those emphasize your technical strategies, and do you like to play those, or is it a watch? Okay, I'm not messing with this stock because it's crazy. So how do you play those types of stocks?
Yeah, so I mean, I like to scout breakouts. I like to day trade breakouts. So that's like a dream, right? Volatility is what I want. You don't want a market, or you don't want a stock that's just moving sideways the entire day. So when I see opportunities like today with GME, AMC, and UWMC, I jump on those opportunities because I know that every $1 to $2 move with the IV on the contracts, on the options contracts, that I'm going to be able to bring in 10 times the amount I would like on normal IV on a normal stock. So I usually jump at those opportunities, especially if the volume's high and I know that the stock, and the only time I'll stay away from these types of opportunities is when it's in uncharted territories. So when GME was in the 300-400s, I wasn't touching it at all. But now that it's back into, where I can chart, find previous support and resistances, line my technicals up with previous time frames, it's a lot easier to handle these situations and handle the volatility. So I'll just buy at support, catch a bounce. I won't even hold to a resistance. I'll just catch a bounce, get out for 20-30%, that type of good stuff. So I really love volatility and volume combined. It's a good mixture. It's just like a scalper's dream.
Absolutely. All right. Thanks, Shinobi. We're going to move on now to Lamonti. Let's hear it.
Hey, thanks for having me. And there's a great panel of speakers up here, and I highly suggest giving each of them a follow, as they're bringing good content to the Twitter platform. But I kind of want to just go over technical analysis from a high level, some of the indicators I use, and then just some things to consider. So in its simplest form, all it is just the study of price and volume of a particular security or industry. There's metrics that can go off of that, but at its simplest form, it's the study of price and volume. And as Shinobi pointed out, one of the key things is technical analysis works because everyone else in the room is using a similar indicator or the same indicator. Without this convergence of opinion and actual action on that opinion, the trend line or the moving average or any other signal, it won't work. So as long as you keep that in mind, then you can kind of use that as a starting point. So one of the things that I like to do, I'm primarily a fundamental investor. Sometimes I'll swing trade. The majority of my positions I'll have for long term, but I like to use technical analysis as another tool in the bag as a way of analyzing a company instead of just solely looking at the movements in its financial statements and fundamentals. This kind of gives me a nice convergence of how price action is working along with the future prospects of the company. And once I see a nice convergence of those two things, it gives me higher conviction to put capital to work. So with technical analysis, some of the things I like to use, I'll sometimes just use a naked chart and draw my own trend lines. One of the things I like to keep in mind is different indicators work for different companies. Companies have these personalities of sorts where I'll actually go back through history and I'll see what works best. Maybe it's a bounce off of the 200-day. Maybe it's that divergence of price action and RSI action or your MACD action. So I'll go back through history and I'll see what's really working for the company. And that's how I'm kind of explaining the personality. From there, that kind of gives me, okay, maybe this is what other individuals are looking at. They're looking at a bounce of the 200-day on this company, and then that's where volume starts to build. And it's actually, at the end of the day, what it is it's more buyers than sellers. It's the whole demand supply curve action of it. And as you have that outstrip of demand over supply, you have price increase, and obviously in the inverse, you have price decrease. So once I find out that indicator and I see if it's worked, I have to ask myself, well, is it going to work again or not? And that's where kind of what Ben was talking about, where it comes into this margin of safety of sorts, where you're giving yourself a nice entry point, a nice cushion that even if it doesn't work, you can quickly exit and still have a smaller loss than you could have had if the indicator didn't work. So some other things that I like to use almost on every company or asset like Bitcoin or other cryptocurrencies, I like to use a 20, 50, and 200-day moving average. So for like a momentum indicator, I'll like to see a shorter term moving average, maybe a 20 or 50-day crossing over a 200-day with volume build. And maybe that's a trend that's going to persist into the future. And I'm not saying it's working off of because of the technicals, but it could be that the technicals are shadowing a fundamental strength that the company has. Some other things I like to look at: volume profile. I like to look at how volume's stacking up or where people are buying shares over a defined time frame. That kind of gives me my over under, my hurdle rate, where people are at from a profit and loss stance. Are the majority of people buying in at $20 a share and it's at 15? They're at a $5 loss right now. How's that going to influence bid and asks when it comes to looking at the company? Some other things I like to look at are I'll always have a MACD on the chart with 12 and 26 EMAs and a 9-day EMA signal line. And then I'll also have RSI. And with RSI specifically, it gets back to the whole what technical is working for that company. Traditionally, it's a 70 is, overbought and a 30 is oversold, but it can change dramatically for every company. You have to find what has consistently worked over time to be able to really define what that indicator's overbought or oversold area is. And then with that, lastly, the only thing I'm looking at is level 2 data. I'm looking at how the bids and asks are stacking up on a company over time. And then at the end of the day, I'm really just using all these tools as a better entry point or a more efficient entry point and exit point on a company.